Hello everyone, here is the answers to the Unit 14 exercises. In exercise number 1, we have Amico Incorporated, who on June 30th called $500,000 worth of bonds at a call price of $105. These bonds were previously issued at face value, so they won't have any discount or premium on the books. We need to record the journal entry to extinguish this debt from Amico's bonds. Well, this is pretty straightforward to do. See, the call price is paying a premium to your bondholders to get out of that debt early. Why would you want to do that? Because it lets you stop paying interest, which means you're probably going to have to pay a price above the face value. In this case, the call price was $105, which means we can buy these bonds back from our bondholders, retire them early for 105% of face value. So it's $500,000 worth of bonds. 105% of that is $525,000. Well, if we're going to pay $525,000 to retire these bonds, but our books say that we have a $500,000 liability because that's the carrying amount of the bonds, that means we're paying more than we thought we were going to have to, or more than our books say we should have to retire these bonds early, which means we're going to have a loss. So that $25,000 difference is going to be a loss on bond redemption. And when we journalize it, we just debit bonds payable to take it off the books at its value. We debit loss on bond redemption, that for the extra $25,000 we have to pay, and we credit cash for the $525,000 we have to pay out to extinguish these callable bonds prior to their maturity. So in this example, these bonds were issued at face value. If you had an example where there was a premium or a discount on bonds payable on your books, you would also have to take that off the books when you are extinguishing your debt prior to maturity, and make sure that you're using the correct carrying amount of bonds when you're calculating your loss. It's not just the face value, it is the face value plus any premium or minus any discount if those things exist. In exercise number 2, we have M&M Manufacturing, who on January 1st is going to settle a debt with Chase Bank. And under the terms of the settlement, M&N is going to surrender 2 delivery trucks to Chase in order to pay off $150,000 notes payable. So apparently we don't have the cash, or we don't want to pay the cash to pay this debt off, this notes payable. We owe Chase Bank, so we are going to surrender 2 trucks to them instead of paying the cash. The first truck has a historical cost of $80,000. It has already accumulated $20,000 worth of depreciation, and it has a fair value, its value on the market, its Kelley Blue Book price, if you will, of $45,000. The second truck originally cost $95,000. It has accumulated $30,000 worth of depreciation, and it has a fair value of $75,000. We need to record the entry to settle this debt via asset transfer. So when we're recording this entry, we need to figure out any gains or losses that we have here. But we might have 2 different types of gains or losses. We're going to have one that might be related to the difference between what our books say these assets are worth and the value we're getting by surrendering them. So let's first go through and see if there's any loss or gain on the disposition of these assets. The total cost of the assets that we're surrendering is $175,000. The first truck cost us $80,000. The second truck cost us $95,000. Together, these 2 trucks combined had a historical cost of $175,000. The first truck has accumulated $20,000 worth of depreciation. The second truck has accumulated $30,000 worth of depreciation. The 2 of them together have $50,000 worth of accumulated depreciation. That means that the book value of these 2 trucks, these assets that we're surrendering, is $125,000. Well, what's the fair value? The fair value of the first truck is $45,000. The fair value of the second truck is $75,000. That's $120,000 in total. So our books say that these assets should be worth $125,000. But Chase Bank doesn't care what our books say. They're going to look into Kelley Blue Book and see these trucks are only worth $120,000. So we're getting $5,000 less value for exchanging these trucks or surrendering these trucks than our books say we should, which means we need to record that as a loss on asset disposal. The other thing we need to check is if there's any loss or gain on this debt settlement. So what was the amount of money that we owed them? Well, we owed them $150,000. That was the face value of the note. And they're letting us out of this by forking over these two trucks. Well, these two trucks only have a fair value of 120 grand, which means we're getting out of this cheaper than we should have. So that's got to be a gain for us. How much is the gain? It's the difference between the fair value of the liability we owed and the fair value of the assets that we are giving up to get out of that liability. We're getting a gain of $30,000 on this debt settlement. So the journal entry to record the surrendering of these two trucks to pay off this notes payable we owed the bank is going to start with a debit to the liability notes payable, taking it off our books because we no longer own it. So we debit notes payable for $150,000. We're going to take the accumulated depreciation for the assets that we're surrendering off the books. That was $50,000. So we're going to debit accumulated depreciation of trucks for 50 grand. Losses, a typo here. That's supposed to be an expense account, not a contra asset. Losses go up on the debit side, and since we have a loss of $5,000, we're going to debit loss on asset disposition for 5 grand. We need to take the trucks that we are surrendering off our books at their historical cost. Well, the total cost of our surrendered assets was $175,000. So let's go ahead and credit our trucks account for $175,000 to take those two assets that we're surrendering off of our books. And lastly, we need to recognize a gain on our debt restructure or debt settlement, which is going to be a credit for $30,000. And lastly, in exercise 3, on December 1st, 2018, Berkeley Bank is going to enter into a debt restructuring agreement with ABC Company. Under the terms of this debt restructure, ABC is going to get the principal obligation they owe to Berkeley Bank reduced from $400,000 down to $250,000. Berkeley is going to extend the maturity date on this debt. So they're going to extend it from December 31st, 2018 to December 31st, 2020. They're going to give ABC Company 4 more years to pay this off. And they're going to kindly lower the interest rate from 7% to 6%. Why would Berkeley Bank want to do this? Something is better than nothing. If ABC Company is that distressed, Berkeley wants to get something out of them. It's better than just saying, we're not going to be able to pay this, so we're going to claim bankruptcy. So they go through and they restructure this debt so Berkeley can get at least some of their money back. We need to record the restructuring of the debt on December 1st, 2018. So let's start with what we have. The new principal balance is going to be $250,000. The new interest payment per year is going to be $15,000, and I found that by taking the new principal balance of $250,000 and multiplying it by our new interest rate of 6%. There are 4 years remaining because they're extending it from December 2018 to December 2022. Well, if we pay $15,000 a year for 4 years, that means that under these new terms, we're going to have to pay $60,000 in interest before we have to pay back the $250,000 in principal, which is our new balance. So in total, the future cash flows that our company, ABC Company, is going to have to send out to Berkeley Bank are going to be $310,000. Well, we owed 400 grand. We're going to get out of that 400 grand for only 310,000, which means, again, since we're getting out of a debt cheaper than we thought we were going to, we have to recognize a gain on this debt restructure or debt settlement. So we have a gain of 90,000, which is a good thing, not only for the company, but for you as an accountant, because when you do this, when there is modification of debt with a gain, it's so much easier to account for than when there's a modification of debt but the company does not experience a gain. See, with this gain, all we got to do is we got to first recognize the restructuring of this debt. We're going to pay them $310,000 in total. And our books right now say we should have to pay them $400,000 from our notes payable. So what are we going to do to rectify the situation? Well, it's easy. We're just going to reduce the value of the note to the total amount of future cash flows that ABC Company is going to have to send out to Berkeley Bank. Since they're sending out $310,000 in total in the future, let's reduce the value of our notes payable by $90,000 and credit it to gain on debt restructure. So now this note is on our books for $310,000 after this entry, which is the exact amount of our future cash outflows to them. which means every time that we go and we pay interest, instead of having to record it as interest expense, we're going to just take that right out of the notes payable. See where this $1,250 come from? Our restructured principal was $250,000. Interest rate is 6%. That's where we get our $15,000 per year from, but we're not paying for the full year. We're only paying for 1 month because it's December 31st. So we multiply that by 1/12. That comes out to $1,250. When we transfer over this $1,250, we're not going to record it as interest because we're going to lower our notes payable by the amount of interest that we're actually paying. And after we have done this for all 4 years, it will eventually reduce the value of our note down to $250,000, which is the principal balance of it. So our note payable will be lined up with the amount that we have to pay off the principal of this note at the end of its life. Essentially, they call this implied interest.